Silver is no longer behaving like a normal market instrument. Analysts who still study it through charts, ratios, and short-term flows are missing the larger picture. What is happening to silver is not a cycle. It is a structural shift. The metal has quietly moved from the world of finance into the world of strategy. For decades, silver traded inside a familiar system. Prices were shaped by futures contracts, leverage, investor sentiment, and industrial demand. Liquidity was assumed, delivery was rarely questioned. The system worked because most participants believed it worked. That belief is now breaking. They live in a world that has changed. The global system that supported frictionless trade has fractured. Supply chains no longer stretch smoothly across continents. Trust between nations has weakened. Monetary rules once treated as permanent have been rewritten in real time. In this environment, silver can no longer be treated as just another commodity. Silver now trades inside a geopolitical framework. This shift did not begin with a single event. It emerged slowly after the pandemic exposed deep weaknesses in global logistics and coordination. Governments learned a hard lesson. Efficiency without resilience is a liability. Since then, physical resources have taken on a new role. They are no longer just inputs. They are leverage. In this new system, price is not determined by how much silver is promised on paper. It is determined by who controls the physical metal, where it is stored, and under which legal authority it sits. Ownership has become less important than jurisdiction. Custody has become more important than liquidity. They are watching futures markets lose influence. Contracts still trade, but their authority is fading. When confidence in delivery weakens, price discovery weakens with it. A market can only function if participants believe the system will honor its obligations. And once that belief erodes, the system reprices risk aggressively. This is why volatility should not be misunderstood. Volatility is not chaos, it is communication. It signals that the old assumptions no longer apply. The market is not unstable, it is recalibrating to a new reality. Many investors still treat silver movements as speculative noise. They assume pullbacks mean the story is over. They assume rallies must be bubbles. They assume that because silver behaved a certain way for decades, it must continue to do so. This assumption is dangerous. They are standing on a map that no longer matches the terrain. The world has split into zones of influence. Nations now prioritize control over critical materials. Smelters, refineries, vaults, shipping lanes, and legal frameworks are no longer neutral infrastructure. They are instruments of policy. Physical silver, once abundant and mobile, is now strategic and constrained. Institutional stockpiles are no longer passive holdings. They are reserves. Decisions about releasing or withholding metal are no longer purely economic. They are political. This is a fundamental change, and it carries long-term consequences. Silver sits at the center of this shift because it plays two roles at once. It is an industrial input and a monetary metal. In stable times, this dual nature suppressed its value. Industrial demand capped upside. Monetary demand faded into the background. For years, silver suffered from being too useful and too ignored. That dynamic is reversing. Industrial demand is becoming strategic demand. Monetary demand is becoming defensive demand. Together, they create pressure that does not resolve quickly. This is not a story of a short squeeze or a speculative rush. It is a story of repositioning in a world that no longer trusts abundance. Those who fail to recognize this shift face a clear risk. They will allocate capital based on models built for a system that no longer exists. They will interpret signals incorrectly. They will mistake structural repricing for temporary distortion. Serious decision makers must adjust their lens. They must ask different questions. Not how high the price can go this year, but who controls supply 5 years from now. Not how liquid the market looks on screen, but how much metal is actually available for delivery under stress. Silver is no longer just a metal. It is a signal. It signals the return of strategic scarcity. It signals the decline of paper authority. It signals a world moving away from assumptions of endless access toward a reality of controlled resources. Those who understand this early gain an advantage. Those who ignore it will be forced to react later, under worse conditions, with fewer options. This is not a warning about silver alone. It is a warning about the system changing beneath their feet, and silver is simply one of the first assets honest enough to show it. The silver market is no longer defined by buyers and sellers alone. It is defined by holders and controllers. This distinction matters more than most people realize. In the current environment, ownership without control offers false comfort. Real power now lies with those who decide where silver sits, how it moves, and under which laws it falls. They are witnessing a quiet custody war. In the past, silver moved freely across borders. Refineries processed it, banks stored it, exchanges cleared it. The system assumed neutrality. Metal flowed to where it was needed, guided by price signals. That assumption no longer holds. Governments now understand that physical control of materials equals strategic leverage. This is why institutional vaults have become critical terrain. A bar of silver in one country is not the same as a bar of silver in another. Jurisdiction determines access during stress. Legal authority determines whether metal can be moved, seized, restricted, or prioritized. In a divided world, these differences become decisive. They are watching nations quietly compete for custody rather than headline purchases. Public announcements are rare. Most accumulation happens through long-term contracts, off-market agreements, and strategic stockpiling. These moves do not show up clearly in daily price action, but they reshape the market underneath. This is not speculation. It is preparation. Some countries import silver from friendly regions and secure it within their borders. Others rely on foreign storage, assuming access will remain uninterrupted. That assumption carries risk. In a crisis, legal systems do not negotiate. They enforce. They are also seeing inventories that appear large but are functionally unavailable. Much of the reported silver supply is already spoken for. It is pledged, encumbered, or tied to future obligations. On paper, it exists. In reality, it cannot be freely delivered. This creates a dangerous illusion of abundance. Futures markets continue to trade contracts representing silver that may never move. As long as confidence remains, the system functions. But confidence is fragile. When participants question delivery, paper claims lose authority quickly. History shows that once trust breaks, it does not return easily. This is why physical custody now outranks paper exposure. Institutional players understand this. They prioritize metal they can touch, audit, and legally control. They are less interested in price swings and more focused on availability under stress. This mindset shift is subtle but powerful. Retail participants often miss this change. They focus on charts and momentum. They debate whether silver is overbought or oversold. Meanwhile, the real battle takes place off-screen in vault agreements and supply contracts. This gap in understanding creates asymmetry. Those who control custody shape outcomes. Those who only watch prices react to them. Another critical factor is geography. Silver does not move without infrastructure. Smelters, refineries, shipping lanes, and insurance all matter. Control over these choke points determines who can convert raw material into usable supply. When these systems are strained or politicized, access tightens. They are entering an era where logistics equal strategy. This shift explains why some regions feel pressure faster than others. It also explains why sudden price moves seem disconnected from visible news. The market is responding to constraints that are not publicly discussed. This is not a conspiracy. It is a function of national interest. Governments rarely announce resource strategies openly. They act quietly, then explain later, if at all. By the time policies become public, positions are already established. This is why waiting for confirmation is costly. For businesses and entrepreneurs, the implications are clear. Any operation dependent on silver, directly or indirectly, must consider access risk. Price hedging alone is no longer sufficient. Supply security matters just as much. Those who plan only for price volatility ignore a deeper threat. Availability risk cannot be hedged easily once stress arrives. It must be planned for in advance. Silver's custody war is not about domination. It is about insulation. Nations are insulating themselves from future disruption. Institutions are insulating themselves from delivery failure. Those without insulation will pay a premium later. This is how strategic markets evolve. First comes quiet accumulation, then comes reduced flexibility. Finally comes repricing. They are currently between the first and second stages. The lesson is simple but uncomfortable. In the new silver market, control beats optimism, jurisdiction beats assumption, and physical custody beats financial comfort. Those who understand this are already adjusting. Those who do not will eventually be forced to, under less favorable conditions. Silver is revealing a truth many would rather ignore. In a divided world, access is never guaranteed, and the market is beginning to price that reality in ways most are not prepared for. Markets often wait for announcements. Serious power does not. In the modern silver market, the most important decisions are made quietly, long before policies are explained to the public. This is where many observers lose the thread. They expect change to arrive with speeches, press releases, or emergency meetings. Instead, it arrives through silence, timing, and preparation. They are watching policy act without drama. Governments understand that sudden moves create shock. Shock creates resistance. So instead of acting loudly, they stretch time. They open negotiation windows. They delay tariffs. They issue broad proclamations without immediate enforcement. To casual observers, this looks like indecision. In reality, it is strategy. Time is being used as a weapon. When a government signals that future restrictions are possible but not immediate, it creates a predictable behavior pattern. Institutions begin to accumulate. Suppliers rush to secure contracts. Friendly regions increase shipments. Unfriendly regions accelerate their own buying. The result is a global race that happens quietly under the surface. During this phase, prices often rise sharply, then fall back. Many interpret this as failure. It is not. It is digestion. They mistake consolidation for weakness. The most misunderstood tool in this process is the price floor. A price floor is not declared. It is built. It It is created when a powerful buyer consistently absorbs supply at certain levels over time. The buyer does not announce this activity, they spread it out. They remain patient. And once enough material is secured, the market changes behavior. At that point, future policy becomes easy. Tariffs, quotas, or restrictions can be introduced without destabilizing domestic supply. The cost is pushed outward. Other participants are forced to adjust to the new baseline. What looks like regulation is often confirmation of a price that has already been established quietly. This is why short-term pullbacks are misleading. They give the impression that pressure has eased. In truth, pressure has only paused. Accumulation does not happen at peaks. It happens during retracements, when attention fades and headlines move on. Those who expect straight-line movement misunderstand strategic markets. Silver is particularly sensitive to this process because it is both visible and ignored. It trades daily, yet few treat it as policy relevant. This makes it ideal for silent positioning. Large volumes can change hands without triggering panic, especially when movements are explained away as speculation. Policymakers rely on this misunderstanding. They allow markets to cool temporarily. They let sentiment reset. Then accumulation resumes. Over time, the floor rises. Not dramatically. Gradually. By the time the public notices, the structure has already shifted. This approach also explains why no tariff announcements can still be bullish long term. They remove immediate fear while preserving future optionality. They buy time, and time is used to secure resources. Markets react to what is said. Strategy reacts to what is possible. They are currently living in the space between intention and enforcement. This space is where positioning happens. It is uncomfortable because it lacks clarity. It frustrates traders who want resolution. But for planners, it is ideal. Businesses that rely on silver often misread this phase. They assume stability has returned. They delay decisions. They wait for confirmation. In doing so, they expose themselves to future cost shocks. Price floors once established do not announce themselves with fireworks. They reveal themselves through refusal. The market simply stops going lower. Supply tightens. Availability becomes selective. Discounts disappear. Premiums creep in quietly. By the time everyone agrees a floor exists, it is already far above where it began. This is why policy-driven markets feel unfair. They reward patience, scale, and foresight. They punish short-term thinking. They are not designed for traders. They are designed for states. Silver's current behavior fits this pattern precisely. Sharp moves, followed by controlled retreats, rising baselines, increasing sensitivity to supply news, declining influence of paper signals. None of this is accidental. Those who understand how price floors are built stop asking whether silver is too high or too low. They ask whether accumulation is still ongoing, whether access is becoming easier or harder, whether future restrictions are more likely than less. The answers to those questions matter more than any chart. Policy does not need to speak loudly to act decisively. In fact, the most effective policy often whispers. And silver, slowly and steadily, is responding to that whisper. The danger is not missing the announcement. The danger is misunderstanding the silence. Silver is not moving in isolation. To understand today, one must look at history. Commodity markets are cyclical, yes, but cycles are not random. They repeat under new rules, often in patterns shaped by geopolitical strategy and structural shifts. The story of silver today mirrors lessons from copper, oil, and other critical metals in the early 2000s, but with one key difference. Silver now straddles both industrial and monetary relevance. They are witnessing a parallel few analysts notice. In 2004, copper experienced a breakout. For decades, it had been a sleepy industrial metal, traded mostly on supply and demand fundamentals. Then, China emerged as a dominant global player. Demand surged. Industrial capacity expanded. Prices were no longer simply a reflection of production, they became a statement of global influence. Silver is following a similar path, except this time, the stakes are monetary as well as industrial. Unlike copper, silver has a dual identity. It serves as both money and metal. Its industrial uses matter, but they are now secondary to the strategic implications of ownership and control. The rise of China in the industrial metals market foreshadowed the current battle over silver. Then, industrial demand reshaped the global hierarchy. Now, monetary metals are taking their turn. Nations are quietly adjusting their reserves, institutions are securing custody, and legal jurisdictions are asserting influence. The parallels are clear, but the consequences are deeper. They are entering a silver reset. This is not about short-term speculation. It is not about a bubble or correction. It is about the market recalibrating to a new reality. Scarcity is strategic, control is decisive, and historical price relationships are no longer reliable. Investors, traders, and businesses must internalize that silver now communicates systemic risk, not just financial opportunity. Historical analysis also shows how timing matters. In the 2000s, industrial metals rallied not because of panic, but because accumulation and strategic positioning went largely unnoticed. Public sentiment lagged behind reality. By the time mainstream attention caught up, markets had already entered a new phase of equilibrium. Silver is following a similar pattern. Early signals, vault accumulation, legal jurisdictional maneuvering, and silent national procurement indicate that the structural shift is already underway. Prices may wobble, but the underlying trend is set by fundamentals that are invisible to most. The lessons extend beyond markets. Businesses dependent on silver or any critical material must adjust their strategies to consider access risk. Price alone is no longer an adequate metric. The difference between being prepared and being reactive is access to physical metal, legal clarity on custody, and understanding geopolitical moves. Failure to account for these factors could be costly, even catastrophic, when systems are stressed. They also must understand the new dynamics of market authority. Futures and paper markets are losing their role as primary price setters. Institutions with deep physical reserves, governments with strategic control, and legal frameworks that secure custody are increasingly shaping the baseline of value. The market is moving from abstraction toward tangible, enforceable reality. Silver, therefore, becomes more than a commodity. It is a signal, a canary in the coal mine for systemic risk and structural transition. Its movements reflect the broader reordering of global trade, finance, and industrial strategy. Those who interpret it correctly gain insight into the future of other critical assets. Gold, copper, lithium, and rare earth elements are following a similar path, each affected by control, custody, and jurisdictional authority. They are witnessing a controlled recalibration, not chaos. Unlike a speculative bubble, this shift is deliberate, measured, and strategic. National interests are quietly asserting themselves, and institutions are acting to secure their positions long before public announcements. Volatility is not disorder, it is information. It signals the realignment of authority over scarce resources and the creation of a new equilibrium for monetary metals. In conclusion, the historical parallels illuminate the stakes. The silver reset is underway. It is shaped by control, not speculation. It is influenced by jurisdiction, not sentiment. And it is guided by strategic foresight, not daily headlines. Those who recognize these forces today are positioned to act with clarity and confidence. Those who ignore them may wake up tomorrow to a reality they cannot influence. Silver is no longer a simple market commodity. It is the pulse of a strategic global realignment, both a warning and a guide for those who choose to see it.